Get tomorrow's news today with the Futures Now newsletter. You'll get the latest news, real-time trade updates, and a sneak peek at our biggest interviews. Stay ahead of the headlines and make today's events tomorrow's profits. Sign up now at cnbc.com/futuresnow email.
Welcome to Futures Now. I'm Jackie DeAngelis coming to you live from the commodity desk at CNBC Global Headquarters. It's another busy day for the markets, and we're here to help you break it down. Here's what we've got coming up on the show. Trump's not the only one who's back in town. Peter Schiff will make his return to Futures Now with some strong words for the president. He's going to break down how the D.C. drama is going to affect the markets. Plus, one of our traders is buying bonds ahead of the jobs report and a key Fed meeting. We're going to have that trade for you later on. But first, stocks hitting all-time highs again as the S&P sets another intraday record. Is there anything that can stop the rally? Let's get straight to it. Our traders today, Jim Iuorio and Jeff Kilberg. Jeff, to you first.
Well, it is unstoppable. Like getting between Iuorio and a canola here. It is unstoppable. Look at where the S&P 500 is, Jackie. It's 500 handles higher from the night of November 8th, the election night. So right now, low volume, low volatility. I don't have the conviction in this current rally. I think we see a little bit of a pullback. Arguably, though, it has been up, and away.
Why? Why do we need? I mean, it just goes, it seems, in one direction. If you want a reason, by the way, I'll give you that. Those two numbers today were both fairly
ADP,
solid,
right?
But on their own is great. But then you look at the prices paid component in the ISM, and that was actually a little lower than expected, and actually lower than the last few months. So you can say to yourself, we're having some decent economic data. Plus, there's not those wage-driven inflation pressures, and the Fed has taken a little bit of a step back in the last few times they've spoke regarding their hawkish
We've also been
bent.
conditioned to the data, Jack. We've been conditioned for weaker numbers. If you were to give me a jobs number, 400,000 back in the day, that's spectacular. Now, 250 is out of the park.
Well, we're going to love 250.
We're going to love 250.
And I was going to say that.
The market's conditioned.
I was going to say, even though the data seems to be improving a little bit, Jim, is it really enough to justify the levels that the market is at?
No, the levels that the market are at are also presupposing that there is eventually going to be some pro-economic policies that are going to squeak through. That might not happen in the next 6 months. It might not happen in this whole year. That's fine. The market is very, very forward-looking. I'll admit that, and it's very, very hopeful right now. But I do believe that those things could potentially happen.
Jeff, when you set yourself up and you're so hopeful, I'm talking about the market collectively, do you set yourself up for failure?
I think you arguably do, and we talk about FANG a lot, or arguably we don't like talking about FANG, but let's look at those FANG stocks. When you see more than 50% of the S&P 500 gains being attributed to 4 or 5 names, that handful, that focus, that concentration is reason to be concerned. And I step back and try to have a 50,000-foot view on where we've been and where we are. So right now, I think the market has been on pause. Financials have taken a break. So the S&P 500, despite the fact we're up another 12.5 handles at record all-time highs, I don't see how this continues in the next week.
So it's going to be you two and Peter and me on this show. So the three of you against me. I can see how this is going to play out.
Pretty much.
Right.
All right. Jim, you're trading the S&P for me. Sometimes we do say on the show, and you've said it before yourself, you don't sort of fight the movement or the momentum. Would you buy it here?
That's what I believe. A little bit of a downtick, 24.19, I think is another spot to get in. It just broke above some intraday highs over the last few days. I think a target of 24.37 on the upside is reasonable. A stop place below 24.08. And again, you hit it right in the head, Jackie. The point is this. The trend is your friend. Am I the world's biggest bull? No, but I've been consistently a bull, and I'm, each time it's be nimble, play relatively small, but I don't think you can fight it.
I'm having flashbacks of you saying don't fight the Fed. It's not really as much about the Fed anymore, but it's the same principle.
It could be again, though. You know what I mean? The Fed,
it could be.
The Fed says they're going to tighten. I don't really believe them, though.
Well, by and large, Jackie, I'm okay with this trade. The momentum is on his side. However, you can pick any spot to get in. When the Dow's down 30 handles, the S&P's down 3 handles, that feels like a good spot to get in this latest run. But I look at 2,400. Look on the chart. We spent a lot of time around this 24. Certainly, we have popped a new high today, but we took a little bit of a pause here from a psychological perspective. And the fact that financials, which have been the backbone since November 8th, have reversed slightly, not all the way, but slightly. I think that's a reason where Jimmy, if he's buying it on the way down here, maybe this is the actual time we see more than 10 handles down and they buy it.
Jeff, the one reasonable point that Jeff has made is that I don't,
all year,
is that I can't Yes, and I do like cannolis. That I can't identify what the next leader group is going to be.
Yeah.
It does seem like the FANG stocks might be played out a bit. I got out of some of those positions this week. The financials don't seem like they're ready. I would love for something to step up. I haven't seen it yet, but that doesn't make me throw in the towel.
All right. Let's go ahead and get the risk reward on this trade. Jim is buying the S&P 2419. He's targeting a move up to, looking here, 2437. All right. Each tick or point in this trade is worth 50, so he's risking 550 to make 900. Okay, speaking of D.C., our next guest sees more road bumps ahead for President Trump. Peter Schiff is the CEO of Euro Pacific Capital, and he joins us now. Peter, I've been on assignment or vacation or whatever the last few times that you're on, so I'm glad to have you back today. Let's get straight to it and talk about the markets and what you're seeing. We just traded the S&P. It seems that the Trump trade is alive and well, and markets are continuing to fly high. What are your thoughts?
Well, I think the trade has unraveled a bit. Remember, early in the Trump trade, you had a strong dollar. The dollar has surrendered 100% of its gains post-Trump's election. And so year to date, even though the S&P is up, priced in gold, the S&P is actually down. And if you compare the U.S. stock market to other stock markets around the world, the U.S. stock market is one of the worst performing markets in the world. So it doesn't sound like the Trump trade is working. It sounds like the trades that are working are buying gold and buying foreign stocks. And that's what I've been doing.
Well, gold's been bouncing around, but we're stuck right now, 1266. That's not exactly a massively successful trade, if you ask me, over the last couple of months.
Well, year to date, it's up more than the Dow. It's up more than the S&P 500. And even though the S&P has made a new high, it's not much higher than it was a few months ago. So the U.S. markets have been pretty steady, while foreign markets have been much stronger. Emerging markets have been very strong. And I expect this trend to continue. And I think it'll accelerate in the second half of the year.
Okay, Jim's going to jump in.
The dollar's retraced everything, as you said. Is the dollar saying conclusively that Donald Trump's going to get no pro-growth policies through? And do you agree with it?
Well, I don't think it's really an indictment of Trump, more of the Federal Reserve. I mean, I think that even if the Fed hikes again in a couple of weeks, I mean, they're nearing the end of their tightening cycle. And, even though the Fed claimed to be data dependent and they hiked interest rates despite the fact that the data was much weaker than they thought, I think the markets are starting to look beyond the hikes to the cuts. I think we're getting ready to start a new easing cycle. And on the other side of the Atlantic, the ECB is getting ready to end their easing cycle and to begin tightening. So I think the currency markets are more looking at that policy divergence than whether or not Trump is going to get anything through Congress.
Okay, Peter, but from a broader standpoint, and the fact that Donald Trump can't get anything done, and we've lost confidence in that Trump trade, and it's unraveled, as you said, him being there and not having another administration that seemed to target corporations. Throw me a bone. Is it slightly more positive than the situation that existed 6-8 months ago?
Well, absolutely. Look, having a president who is business friendly as opposed to the enemy of business is a good thing. But look, the valuations are not going to help Trump. Remember, when George Bush took over from Bill Clinton, he was obviously more friendly to business than was Bill Clinton, but it didn't stop the stock market from collapsing because when he took office, valuations were extremely high, and we had the Fed propping up the market with aggressive monetary policy. I mean, not nearly as aggressive as it's been recently, but I think Donald Trump has walked into a similar situation as George Bush. So even if he's friendlier to business, it doesn't mean the stock market's going to do well under his presidency.
Peter, you and I haven't talked in some time, but you have come on the show a lot telling me that the Fed has no option but other than to institute more quantitative easing programs and that interest rates would stay at zero forever. That doesn't seem to be the case. What are the Fed's moves now?
Well, the Fed is still very close to zero. I mean, really, the target rate is still below 1%.
Okay, but we're looking at potentially two more hikes this year.
Well, even if we get two more hikes, you're looking at interest rates that in real terms were negative. If you take the interest rate and subtract it from the inflation rate, even the one that the government reports, you're looking at negative interest rates. But if you actually look beneath the government statistics, look at how weak the economy has been. I mean, you can see that in the retailers that are blowing up, all the stores that are being shut down. You can see it. Look at the auto sales that are out again today. Look at the inventories piling up. Look at all the debt that consumers have racked up, credit card debt, auto loans, student loans. Look what's happening with labor force participation. So the economy is still weak despite all of this Fed stimulus.
Peter, you have to, the things you just threw out there, when you said about retail, you have to admit that's more of a Jeff Bezos factor than it is of any sort of commentary on the consumer. You do not agree with that?
No, I don't. I do agree that more people are shopping on Amazon, but the sales at Amazon do not equal all the sales that are being lost at all the brick and mortar stores that are shutting down. Yes, the market share at Amazon is growing, but the overall market is shrinking because Americans are broke. They have lousy jobs, they have no savings, and they're maxed out on their borrowing. And a lot of Americans that used to have home equity no longer have homes. They're now renting, and their rent goes up every year.
Peter, bringing it back to D.C. and, your sort of take on the markets at this point, if Trump doesn't get any major policy reform through this year, what happens? Do we crack?
Well, look, I do think that we're going to get some combination of tax cuts and increased government spending through Congress. And it may be the reaction to the fact that we go back into recession and it's sold as a stimulus rather than as tax reform. But unfortunately, there's no real political courage among the Republicans to do what's right when it comes to tax reform, repealing Obamacare, and not replacing it with anything. We need the free market to solve our health care problems, not more government. And the other problem is Trump himself, when he ran for president, he promised not to touch entitlements. He promised to increase spending on the military. And we're not going to make any real progress on the deficit unless we cut entitlements, unless we cut military spending. So once you take that off the table, it doesn't really matter what they do with the discretionary spending because it's not enough to make a real difference.
Okay, Peter, always great to have you and to get your views. We'll talk to you soon. Okay, Jeff, let's get straight into it. As I mentioned, gold trading 1266 now. Peter is saying that, this has been a stellar trade. I looked year to date, we're up 10%. So would you be a buyer here?
I think you can be a buyer here at the right level. And I'm looking at 1260 at my level, just about $3 lower. And why? By and large, due to the way I envision the stock market, I see a lofty price right here. So any type of retracement, any type of normal, healthy pullback in the S&P should vault the gold trade up to 1,300. So I'm trying to be a buyer here at 1260, looking for 1285 my target, being mindful of that 1250 level, and I'm stopping out at 1245.
I like this trade a lot for more medium and longer term than Jeff does too. I've liked gold for quite a while. Okay. I agree with about 70 to 80% of what Peter says half the time. What I don't agree with is that we are on a one-way course and there's no possible way to deviate from it. But as far as the gold thing goes, I like the trade a lot. If the dollar breaks through 96 on the downside, I go from liking it to loving it.
And that's the key component. I think Peter, he gets off the reservation a little bit on some of his views, but he does hit the nail on the head. The 6% drop in the dollar since January 1st, that's problematic and astounding. And Janet Yellen is quite perplexed. She's got to be scratching her head right now. So there is a panic level in the U.S. dollar index where she potentially reverses course or at least slows down the rate normalization.
But wait a minute.
In itself, Jackie, buys gold.
How much does the drop in the dollar index actually have to do with what's going on here versus the other currencies that we've been watching closely, too?
I think it has everything to do with here. This is a currency war. We've been in a currency war ever since we rolled out QE. So that ebb and flow, the BOJ, ECB, and the Federal Reserve, I think it's all by and large, and Janet Yellen's losing right now.
Yes, but Jackie, you make a good point.
But some of those currencies are moving for reasons that don't have to do with us.
You're kissing up right now.
No, we were pricing in apocalypse in Europe, and it doesn't seem like it's going to happen.
Enough.
They're almost getting to the point where they're going to be in a tightening cycle. I agree with you 100%. I'd say it's 50-50. I think we have taken out the Trump trade when we've seen how difficult it seems for anything to be passed.
But you have to agree, the Fed wants that dollar stagnation. They loved it when it was at 100, 101. Right now at 97, they are scratching their heads. This is the first time Janet Yellen's been really perplexed, I would say, in her policy
One of the
years.
reasons they talk tough, in my opinion.
Okay, guys, we do have to move on, so let's get the risk reward on the gold trade. Jeff's buying at 1260. He's targeting a move to 1285. Each point in this trade is worth 100, so he's risking 2,500 to make 1,500. Moving on to the final trade of the day. Speaking of the Fed, Jim's trading the 10-year ahead of the jobs report for us and next week's big Fed meeting. What are the levels, Jim?
It's still a little below the stop-in level. 126.17, I think, is a spot to stop yourself in for a long. Looking for 127.13 on the upside. A stop placed below 126.04. One of the things I'm keying on here, and I know when stock markets rally, it's a little more difficult for the long end to rally, but I did see that prices paid component of the number today and thought, wow, the Fed, unless we're getting some great numbers, may start walking back their tough talk, in which case I think stocks and bonds could potentially rally together.
short term, I'm not going to push back too hard on this trade just due to the fact where I see the S&P 500. But longer term, I'm not going to agree. Why? The Fed at 260, they raised rates a month and a half ago, 2 months ago, right? Now it's at 222.
Right.
This is the low end of the 10-year yield. So the Fed, they have to continue to chirp and talk to try and get that long end of the curve up higher. And I think that's really problematic. And they're gonna falter, they're gonna stumble, but they are gonna be very forceful in their message on the long end of the curve.
By the way,
moving it higher.
just to be clear, though, for the last couple months, yields have been trending lower at the same time the stocks have been making new highs, week to week. And that's something that's interesting to me. The one thing
Yes, but
that
the
I like
curve
about this
flattening
trade,
is the
and
problem.
I'm curious if you like this too, it seems to me that the stocks and bonds could rally together. If stocks all of a sudden start to head south, then all of a sudden bonds flip from being just a haven to a safe haven, and all of a sudden they could get their normal inverse
And they could.
relation.
And if we really see the market pull back here, when you look at the 10-year here in the United States versus the 10-year anywhere else in the world, yes, it is juicy. There's some meat on the bone. And that could obviously be a little win in your sales. But right now, I think the Fed is going to grab that microphone until that June meeting where they are. The CME tool here, the FedWatch tool, it's like a 92% chance of moving.
June is a done deal. And let's say tomorrow is a disappointment. I mean, they're going to go in June. I believe that. There's no question.
You think if we have a 50,000 job number, they're on pause?
No, I don't think that. I think if they have a 50,000 jobs number, we take it from 90% to 60%, and then I still think they hike in June, but I think their rhetoric switches.
Jim, given that we have a new president that is tweeting up a storm.
We do. Yeah, you're right about that.
Heard about him.
Just, a few headlines coming out each day about what's going on in Washington. Do you think this is a more volatile summer than we've seen in the years past, and should investors brace for that?
I think that I hope so, because I like volatility as a trader. From a citizen standpoint, though, yes, I worry about it. And that's one of the reasons that I have been talking about gold for the last few months, because the one thing we have to agree on is that the situation in Washington is clearly less predictable than at any time I've seen in my lifetime. So things like owning gold, probably owning U.S. bonds, too, despite the fact that the problematic headlines could be coming out of the U.S., people still tend to buy bonds. So underline that fact, once we got downgraded once, and the reaction in the bond market was to buy, not sell the very thing that was downgraded.
I think it's also important to remember that we were bracing for volatility with a new President Trump. The market has never been less volatile from a realized perspective.
Amen.
The VIX is at 10.
Well,
we have seen zero volatility since he's taken over. So I think you have to be conditioned
really
to understand, yes, it can revert.
But there's a reason for that, because nothing really has happened yet, despite all the headlines that we've seen. If some of these stories, these side narratives, and some of these themes pan out, i.e. Russia, could we have a bigger problem on our hands?
Are you asking this question because that's what you believe too? And remember, we're talking about this partly as traders, but partly as just citizens.
Right.
You're plugged into the news every bit as much as we are. You're saying it because you believe that he's a wild card and there could be something crazy that comes out of it. Yeah, sure, I agree with you.
I'm just,
Jackie,
look, I saw the tweet the other night.
We have seen a lot of crazy.
In the middle of the night, Kolfefe or whatever it was. Remember, did you see
yes.
that? I mean,
you don't know what Kolfefe means?
You don't know what's going to come out.
On at that day?
Pull the political views aside here. All I'm just saying is that we have seen some sensational news cycle. We have seen some craziness stem out of the new administration. It hasn't translated into any type of volatility. It's actually suppressed volatility.
You're right about that.
So that's my only point. We continue to brace, and we're hitting all-time highs, and the VIX is dipping under 10 here as we speak.
Okay, let's get the risk reward on this trade and put this show to bed here. Jim's buying the 10-year note, 126.17, targeting a move to 127.13. Each tick in this trade is worth 31.25, so he's risking just over 405 to make 875. All right, that's going to do it for today's show. Thanks so much for tuning in. My thanks to Jim and Jeff coming to us from Chicago. Meantime, if you missed anything, head back to the website, futuresnow.cnbc.com. Everything is there for you. And for the latest headlines and a sneak peek of what's coming up on the next show, be sure to sign up for our brand new newsletter at cnbc.com/futuresnow email. You can find that link and real-time trade updates on our Twitter account. Handle there is at CNBC Futures Now. Otherwise, we'll see you for our next live broadcast next week, Tuesday, 1 p.m. Eastern. See you then.